All right. And before we begin, maybe just let me explain to everybody the backdrop of the macroeconomy that we're facing right now. So there are basically a series of interest rates hikes by the US Fed. And as usual, as interest rates go up, there's a stronger incentive to save money, right, for interest, because, you know, bank deposits, if the rate is getting higher and higher, why take a risk and invest, right? Where you can put your money in a bank and you just collect interest without taking on any risk. And so this is what I think a lot of ordinary Singaporeans are thinking. But if you broaden it, right, and you think about companies doing that as well, why do I want to launch a risky project implementing a distributed ledger in my company where I can use the same amount of money and maybe put it in some structured deposit for 6%? Why do I want to launch this technology project? And because of this, right, a lot of riskier projects get cancelled and demand is going to drop across the entire economy. Okay, this is basically how a central bank fights inflation. Okay, and when in the middle of a third 75 basis point interest rate increase, okay, and markets have tumbled for the past 2 days, and the next increase is likely to happen on the 1st to 2nd of November. All right, so I think if you're looking at what's happening right now, is that as interest rates go up, you find that there is a lot of pressure to sell bonds. So the bond bubble just exploded. And bonds have been losing money, all right, for the past few days. And people are now waiting to see whether it is worth adding bonds into your portfolio, all right? And so this is the position where robo-advisor is going to come in extremely handy, okay? And obviously when bonds, if you want to buy some bonds, right, the best way of doing this is through exchange traded funds. So in the ERM program, I've always emphasized to the students that I don't teach people how to invest in ETFs. Well, that position is slowly changing as we move to batch 28. Okay, so ETFs are collective investment schemes. Okay, they allow you to enable passive investing across multiple equity counters. So the STI ETF basically with one counter lets you buy 30 stocks in the Singapore stock market, 30 of the largest market capitalization. And as much as I like to wish that my own portfolio is outperforming it, that's not happening right now. So the STI ETF has been outperforming, all right, the ERM portfolio, all right? So the reason is because 45% banks, and banks are doing well. So the cheapest ETFs try to mirror the movement of an index fund. It tries to give you the average results, okay? It doesn't attempt to try to outperform. And the beauty is that fees can be as low as 0.2, 0.1 a year, okay? Okay, so that's the advantage of an ETF. Of course, some disadvantages do occur. In the US, they levy a 30% withholding tax on dividends. And so a lot of people talk about substitution, right? Where we substitute an ETF with this thing called a UCITS equivalent traded in the London Stock Exchange, which is done to reduce taxes. Now, I'm not putting a lot of details here, but the details will be expanded in the actual course material. All right, so for example, like an equity fund with Vanguard can be replaced with SWRD that's traded in the London Stock Exchange, all right? Yeah, so an example of an ETF, right? I've spoken about the STI index, and it's a very cheap way of earning all 30 stocks in the Straits Times index at a fee of about 0.3% a year, all right? So this is basically ETFs, all right? Now, how do robo-advisors generally work is that they allow investors to own ETFs in a systematic manner, right? So for a fee of about 0.2 to 0.8%, what a robo-advisor does is that they will allocate your assets automatically, mechanically, between a stock ETF, a bond ETF, and a commodities ETF, right? Something like that, okay? Yeah. Now, there are a lot of problems with robo-advisors that I have in Singapore, and a lot of people have asked me what I think about robo-advisors, and I think what I've been doing for the past year is that I've been keeping silent because I do see robo-advisors as the lesser evil. I mean, if the robo-advisors succeed, right, then financial advisors would not have so much commissions to earn, all right? Because the robo-advisor at the end of the day, the fees are very reasonable, 0.2 to 0.8% on top of your expenses for your ETFs, right? So in a world where robo-advisors were to become the main approach where ordinary Singaporeans can own stocks and shares, that's not so much of a bad thing, right? Because we're not like paying very expensive commissions to people that, you know, would like give you a balloon and snatch the balloon away from kids. So so that's basically what robo-advisors do, right? Now, there are some problems with robo-advisors. Now, the truth is that they're like startups, right? So robo-advisors, I would say, is it very different from our cryptocurrency startups, right? Now, they are running on VC funding, and as interest rates rise, you find that venture capitalists, right, would want their money earlier rather than later, right? Interest rates go up, what would happen is that the discount rate to discount all these future cash flows becomes higher. So VCs will become impatient, all right? And they are just being logical. They'll become very impatient. They might push robo-advisors to become more profitable, so which means the annual management fees can go up, all right? Or some of them, if they cannot generate enough assets under management, they might shut down, right? Money gets denied for them. So I think that I'm going to try, and what I've been planning to do for months is to see whether I can show people how a robo-advisor works. And in fact, if I can engineer a tool that mimics a very simple robo-advisor, right? And that would be something which I think my students and the community can benefit from on an ongoing basis. I have been thinking about this for a very long time, but I only started to sit down and actually started coding when I felt that I think the need has become higher and higher now, that interest rates will go up to maybe 5 to 6%. Maybe in 2023, it'll trigger a recession, but I don't think the Fed cares. And then owning a bond portfolio would be rather profitable because you can get like 6% coupons for your US bonds, right? So that is one of the scenarios that can happen in the future, all right? So, all right, so what are the key asset classes that you want to play with if you design your own robo-advisor? So obviously equities and stocks are very important because they do well in like major parts of the market cycle, right? Except this period of time, there's a tendency to do well. Okay, it can fight inflation fairly well, all right, and return, give a real rate of return of 6.8%. Another asset class that's really good are real estate investment trusts. So when you're buying land, you're buying property, right? Property will always be there for like the older generation of people, so property will do well. Bonds will become an increasingly important asset class next year after another spate of interest rate increases. So, so in that sense, you're lending money to these companies. And finally, commodities, right? Commodities and bonds are negatively correlated to each other. So if you own commodities and bonds at the same time, they will rarely drop together. All right, they will rarely drop together. Now you see equities and bonds can drop together, like what's happening right now, but at least you're not seeing commodities join that mix. Okay, so one way of understanding how a robo-advisor works is basically shuffling 4 asset classes, right, in the computer algorithm. Okay, so that's a very simple way to build a robo-advisor. So you can imagine, right, 4 ETFs. I'm just going to list 4 ETFs representing each asset class. The Vanguard Total Stock Index Fund, VT, okay, the expense ratio is only 0.08, right? So it's something that many like retail investors can buy. There is the Total Bond ETF, right? The expense ratio also 0.08, even gives a yield of 2.73, and is steadily rising, right? Steadily rising as interest rates go up, right? So it'll become very viable maybe next year. And then there is the REIT ETF, RET, okay, slightly higher expense ratio, provides decent dividends, in fact, higher than the bond ETF right now. And there's a commodity index, which gives you diversified exposure to commodity prices. This is an expensive commodities fund, all right? Now, when I talk about these 4 ETFs, take note that a lot of savvy investors know how to look for the UCITS equivalent in the London Stock Exchange. It's not a main part of our discussion, but you can substitute it, right, with the equivalent, all right? I think it's actually better because you can save a little bit on dividends because somehow Irish domicile ETFs have a slight tax advantage compared to the ones sold in the US. So if you're interactive brokers and they trade on the London Stock Exchange, you can swap these out for a different ETF. All right, that doesn't really matter to me. You can do your independent research and you do that. Okay. Now, I basically did something which any ordinary person can do. I built a portfolio that allocates equally to all 4 of these ETFs. And over the past decade or so, its return was about 7%. The standard deviation is about 13%. It's not too bad. So basically what it's saying is that you get a lower return than stocks, but the risk that you're taking is significantly lower. I think about only 60 to 65% of the risk. So with a number like this, right, it's something that you can credibly put in 25, 25, 25, 25, and you can have a very good life just building a portfolio like that. Okay. Yeah. So this is the slide that talks about UCITS. I've only managed to substitute the Global Equity ETF into IWDA.L and the Vanguard Global Aggregate Bond Fund. All right. So you can actually go for these tax advantage kind of ETFs if you so wish. All right. Interactive brokers have them all available for you. All right. Okay. So basically that's what robo-advisors do. Robo-advisors, the idea is maybe there's a different way which I spread my money between these 4 assets, right? I can come out with better returns, okay? And generally, for the students of my program, you know that I'm not a big fan of pure returns. I'm a big fan of risk-adjusted returns because over time, you might want to leverage your holdings. And if you can get the same return at a lower risk, right, it's actually safer for you to actually borrow money and then pump your money into these exchange-traded funds as an advanced move, all right? But so the first slide I'm going to put up about the strategy is that you can put 25% each. They're good enough, all right? And you don't need a robo-advisor, okay? And if you do this, you don't have to pay these robo-advisors the 0.2 to 0.8 commission so that they put beautiful people, actresses, all these wonderful people on the poster board, right? So what these companies spend on advertising actually could have been given to you in the form of lower expenses, right? Right. So, so if you can do this, you don't need a robo. All right. Okay. So that is the idea behind the permanent portfolio, right? Where Harry Brown has a strategy that mixes all these assets into an equal proportion. And even Alvin, right? My business partner, Dr. Wealth, has written a Singapore permanent portfolio book, right? So you can get hold of these books and they will explain to you how to do this, okay? So one idea about the permanent portfolio is that it tends to do better when markets are not doing so well, like right now, but it tends to be forgotten when there's a boom going on, right? So what I think financial students, right, those with a finance degree, this is a very familiar diagram to them. It's called the efficient frontier. And for the layman, I'll do my best to explain to you what it is, okay? Whatever's available in the markets right now, there is a line that's drawn, right, that gives you basically the highest return at the lowest possible risk, all right? So if you look at a return of about 10%, okay, this is basically how much risk, right, that you must be able to take. And generally speaking, there is a positive relationship, right, between risk and return, okay? Yeah, but because of the magic of assets that tend to be uncorrelated, right, by combining different asset classes, it actually begins to curve after a while, right? Yeah, so if you can invest, right, along this thing known as an efficient frontier, you are in essence, right, in fact, from here to here, right, you're getting the best return that is possible for that amount of risk that you're willing to take, okay? Yeah, so one of the weaknesses of the permanent portfolio is that you're splitting everything evenly. The point at which you are investing is somewhere in the middle where this yellow dot is, right? And people are dissatisfied because if you're investing here, right, I can always get the same return at a much lower risk. I can always get the same return at a much lower risk, right? So that's where computers have come in to basically calculate where these other data points are. But it isn't necessarily 25, 25, 25, 25, all right? So I'm going to walk through these several variants to you, okay? So the first, which is taught and got a Nobel Prize, is mean variance optimization. and this is taught in every CFA or every master's in finance class, where the idea is that if you have a risk-free asset, like currently if the risk-free rate is 3%, I draw a line that creates a tangent, right, around the efficient frontier, and I invest at that point, okay, this will give me the highest return that's possible given this combination of assets, all right? And basically that's where the story ends in graduate school, all right? So you do a master's in finance, you do a finance specialization in business school, right? They will explain to you what this efficient frontier is, and then they will say that I draw a tangent here from, this is your DBS multiplier, the kind of return, you know, your OCBC 360, right? Right, yeah. So that's the point where you invest, all right? And that's basically where I started when I programmed this diagram. Then you realize that there's actually a lot of problems. Even though this is the best place to invest, right? This dotted point moves around a lot, okay? Moves around a lot, which means that it's very unstable. And that if you design a robo-advisor around it, you keep doing a lot of friction, a lot of trading expenses, right? To maintain that optimal point, okay? Yeah, and the other problem is that if you were to invest at that point, some asset classes will totally disappear from the portfolio, right? So you might not see, for example, commodities in the final portfolio. So it's really a theoretical construct, and it's really not something that you can actually actively trade on, right? Yeah, that's why financial professors are not the wealthiest people or the best investors out there, right? This is actually the reason. Yeah, you can study this, but you cannot get rich for this. And so, okay, at this point, the lecture gets very hard and arcane, all right? So one proposal, right, from quantitative guys is that we don't try to aim for this point because it's too unstable. But this point is very stable, okay? This is the bottom of it. So you basically build the minimum variance portfolio. This is the minimum variance, right? The minimum volatility, okay? If you invest at a black dot, you don't have to like turn over your portfolio. You can like change it every year, okay? Yeah, but there's a slight problem with that. Obviously, the first problem is that your return is not the best. Okay, your return is not the best. So typically these hedge fund guys, right, they will try to leverage. Okay? And the other problem is that it also doesn't invest in every single asset class. So actually it might not be as well diversified as you think it is. Okay, the computer formula, the mathematics behind it is to actually basically move down this curve until you get the minimum point. Okay, and while I do not completely understand this arcane mathematical formula, I'm able to find like at least some programming code that can do it. All right. Yeah, otherwise I won't be able to target the black dot on my graph. Okay, so I'm able to at least implement it for the students. Okay. All right, and the fourth formula, which is I think the one that ERM will choose moving forward, is the risk parity portfolio. Okay, and the best way of understanding risk parity portfolio is to understand what happens when we do risk parity between stocks and bonds. All right, so let's start with a 2-asset class robo-advisor. That one you can use your hand to calculate how to allocate. All right, so the students in my program know how to get the annualized return and the annualized standard deviation, right? So how much do you put into stocks? Okay, you put the standard deviation of bonds divided by the total standard deviation of both products, right? It's like principle of moments in physics when you're studying in secondary school, right? So stocks, okay, will take up 20% of the portfolio, bonds will take up 80% of the portfolio. The reason being that the standard deviation that they provide to the final portfolio is the same. That's why risk parity is the same, okay? Risk parity. So this is the concept behind equalizing the risk that each asset class contributes to the picture, right? So if you have a very risky equity portfolio, you contribute less. If you have a very low risk portfolio that has a very low standard deviation like a bond, you contribute more, right? Contribute more, okay? Now, sadly, right, the mathematics, as you go to 3 asset classes, 4 asset classes, 5 asset classes, become very difficult to understand. Okay, and this is how Bridgewater, which is the Ray Dalio, I think hedge fund, they made most of their money. All right. So risk parity portfolios, while they hug very closely to the efficient frontier, they actually lie within this area. All right, they're actually not on the line. Okay, so they are just slightly a little bit further away because every portfolio contributes something. So every asset class is included in the portfolio. So you don't have to do a lot of reorganization of your ETFs when you rebalance every year. Okay, and it gives you a decent kind of return. So it's sort of like a compromise, right? So the red dot is where ERM students generally of the future are going to play. Okay, yeah, and so if you do that, then the idea of adding leverage to a risk parity portfolio has some benefit because that's actually how the hedge fund guys make money. So they run the asset allocation formula, and then after that, they calculate the risk, and then they decide to borrow money from the broker, and they will then try to leverage it. All right. So this is how they can beat the return of, for example, 100% equity portfolio, even though they have a lot of bonds and they've got a lot of commodities in their mixture. Okay. Okay, so this basically, this is a short section. We've concluded the first part. This is just a glimpse of the future of ERM, where we actually now have an algorithmic approach towards allocating our asset. So in the past, you notice that I get everybody to vote for the asset allocation, right? In the future, we're not going to do that anymore. In the future, we're going to actually have a program, a computer program to tell you how to allocate your asset. Okay, yeah, and we've covered 4 schemes to do that. All right, the first scheme you can do yourself is to allocate equal parts, 25, 25, 25, 25. The second is to use mean variance optimization, which is taught in finance classes and taught by academics, right? Drawing a tangent from the risk-free rate at 0 risk, and then touching the efficient frontier, all right? So there's always a perfect place for you to balance out your portfolio, all right? Very theoretical, very hard to do, and requires a lot of rebalancing. Right. The third approach is the minimum variance portfolio that actually tries to reduce the amount of risk you have to the portfolio. Okay, so you pick up the black dot, right, at the just at the extreme left of the efficient frontier. And finally, the most exciting one that made Ray Dalio as wealthy as he is today is the risk parity portfolio, or it equalizes the risk contribution of each asset class. All right. Yeah, there's a complicated set of maths that shows you how to perform the optimization. Now,